What is up, everyone? Welcome back to the Coder's Trade. Today, we are cracking the code on the world's biggest money game, Forex trading. But before we drop the beat, listen to this legal disclaimer. Trading non-INR pairs or using unregistered brokers in India is actually illegal under the FEMA Act. So, don't play with fire. Research thoroughly and stay compliant. Your money, your life, your call. Now, let's see how this $6 trillion beast works. So, what is Forex? It's basically a global currency swap meet. It's the largest financial market on the planet, moving over $6 trillion every single day. Why is it a favorite? Leverage. You can control a massive position with a tiny deposit. It's like buying a mansion with the price of a bicycle. 24-hour market. It never sleeps from Monday to Friday. You can trade in your PJs at midnight or during your lunch break. High liquidity. You can jump in and out of trades instantly. No waiting for buyers or sellers. Low costs. Most brokers earn through the spread, so no hidden robbery fees. Who are you fighting against in this ocean? Central banks. The ultimate power players like the Fed or ECB who control interest rates. Commercial banks. The backbone of the market, moving the most volume. Corporations. They aren't here to gamble. They are hedging to protect their global profits. Retail traders. That's us. We're small, but we are a rapidly growing army. Hedge funds. The aggressive pros using complex math to exploit every tiny move that in Forex. We trade in pairs. You don't just buy a euro. You buy euro to US dollar. Base currency. The first one listed, the one unit you are buying, quote currency. The second one, how much it costs. Major pairs. The celebrities like euro to US dollar or pound sterling to US dollar. High volume. Low spreads. Exotics. A major currency paired with a smaller economy. High risk. High cost. Stay away if you're a newbie. Bid/ask. The bid is what you sell at. The ask is what you buy at. The difference is the spread. That's the broker's cut. Now, let's talk about your superpower, leverage. With a 1-to-100 ratio, you can control a $100,000 position with just $1,000 in your account. Margin. This is the security deposit your broker holds while you trade. Warning, leverage magnifies profits, but it also magnifies losses. If your account falls too low, you'll get a margin call, and the broker will shut your trades down faster than a door in a storm. How do we measure success? PIP, percentage in point, usually the fourth decimal place in a quote. If euro to US dollar moves from 1.2345 to 1.2346, that's 1 pip. Standard lot, 100,000 units. 1 pip here is worth about $10. Mini lot, 10,000, and micro lot, 1,000, perfect for beginners to practice risk management without blowing their account. Why does the price move? Fundamental analysis tells us the why. Interest rates. If the US Fed raises rates, the dollar becomes a high-yield asset and everyone wants to buy it. Inflation. High inflation usually weakens a currency's purchasing power. Geopolitics. Elections or wars can send investors fleeing to safe haven currencies like the USD or JPY. Technical analysis is the win. We assume the trend is your friend. Moving averages. MA smooths out the noise to show the trend direction. RSI tells you if the market is overbought, too expensive, or oversold, too cheap. Fibonacci. Mathematical levels where the price loves to reverse. Candlesticks. The visual story of the fight between buyers and sellers. Don't forget the market mood. Sentiment analysis is about crowd psychology. COD report. See what the institutional big money is actually doing. Retail sentiment. If 90% of retail traders are long, the pros might be getting ready to short the market and take their money. Don't follow the herd into a trap. How do you want to play the game? Scalping. In and out in seconds or minutes. High energy, high stress. Day trading. You're flat by market close. No overnight nightmares. Swing trading. Catching the trend for days or weeks. Position trading. The long-term macro play. Months of holding. Algorithmic. Using Python or MQL4 to let the robots trade while you sleep. Choose what fits your personality. Manage your risk. All right, fam, let's talk scalping. This is for the adrenaline junkies. Scalping is about making dozens of lightning-fast trades a day to catch tiny price movements. You're in and out in seconds or minutes. The tools. We use Bollinger Bands to see volatility limits and RSI to spot when the market is overtired. You need a tight stop loss, 3 to 5 pips, because if you're wrong, you need to get out fast before the loss grows. Next is day trading. This is the sweet spot. You open and close everything within the same day. No overnight stress. The goal: capitalize on daily news and volatility. Risk control: never risk more than 1% of your capital per trade. If you hit a 2 to 3% loss for the day, walk away. The market isn't going anywhere, but your money will if you revenge trade. For those with a day job or a busy life, swing trading is your best friend. We aren't looking at 1-minute charts. We're looking at daily or 4-hour charts. The game: you hold trades for days or even weeks to catch a massive swing in price. The tool: MACD helps us confirm if the momentum is actually shifting before we jump in. Pro tip: set widgets stops. Since you're holding longer, you need to give the price room to breathe through the noise. Now we're talking the big league: position trading. This is pure macroeconomic investing. The duration: you hold for months or even years. The logic: you don't care about a tiny news release today. You care about central bank policies and the economic health of entire nations. Be aware of swap fees: interest paid/earned for holding overnight. Want to trade while you sleep? That's algorithmic trading. The tech: you use languages like Python or MQL4/5 to code your strategy into a bot, expert advisor. Why? It removes human emotion, the fear and greed, and follows the rules 100%. The kill switch: always have one. If the market goes black swan, crazy unexpected event, your bot needs to know when to stop. Listen up. This slide is more important than any strategy. Risk management is how you stay in the game. 1 to 2% rule: never risk more than 1 to 2% of your account on a single trade. Risk to reward: always aim for at least 1:2. If you risk $10, you should be aiming to make $20. Insurance: a stop loss is your insurance policy against a catastrophic market move. What does the chart move? These are the catalysts. GDP: the report card of a country's health. NFP: US, the godfather of news releases. It happens the first Friday of every month and tells us how many people got jobs in the US. Interest rates: this is the #1 driver. Higher rates usually mean a stronger currency. Ready to level up? Hedging: taking opposite positions to balance your risk. Carry trade: borrowing a low-interest currency to buy a high-interest one, basically getting paid daily interest just to hold a trade. Psychology: trading is 90% mental. You have to overcome fear and greed through journaling and discipline. Let's see it in action. Case 1: trading the NFP release. We use a straddle strategy, placing orders above and below the price before the news drops to catch the spike. Case 2: spotting a double bottom pattern on a daily chart. When the price breaks the neckline, that's our signal to go long. To wrap it up, Forex is a double-edged sword. Respect the leverage. Discipline is king. Stick to your stop loss and position sizing. Stay compliant. In India, follow the FEMA Act. Only use SEBI-registered brokers and trade INR-based pairs to stay safe. Master the skill first, and the money will follow. Visit the coderstrata.in for more.
Thank you. I hope you understand this, and please don't forget to like, share, and subscribe. I will also appreciate any suggestions in the comment section, and please visit our platform, The Coders Trade, with the link given in description.